Hello, how's everyone doing today? It is April the 15th, 2026. I'm David, and I am the lead instructor here at DoctorVol. We're going to go over a couple of things today, and more centered around the strategy of the double calendar spread. Let me adjust a couple of things really quick for everyone to see a little better here. Let's go ahead and let you see my entire screen here. All right. So what you're looking at here is just an interface to communicate with the broker Tradier and also TastyTrade, the two brokers that I use primarily. This interface is through Cloud AI. Basically, we can communicate in plain language with the broker itself, or with the platform itself through API. So anyway, long story short, let's look at the double calendar spread for Netflix. Netflix has an earnings coming up, and this is the double calendar setup that I have for Netflix. Let's zoom out a little bit so you can see how that looks. And as you can see, the double calendar has 2 points of maximum profit, one at the strike price of 90 and another at the strike price of 110. All right, so let's go ahead and progress forward in time. By the way, this is Option Strat. You can find a link in the description for Option Strat. It's a very good tool to use to give you a great visual of profitability zones, or tents, as people often call it. So anyway, this is the progression or the lifetime of the trade at expiration. It will look something like this. Now, there's some variables in this. The main variable is volatility. We don't know how much volatility will contract after the earnings announcement happens. So that's going to determine how this front month, April 17th expiration, behaves. So you may have a contraction. And if you do, you will see some differences in the maximum profit. So also, let's say tomorrow morning, let's go to tomorrow morning, Thursday, let's say at 10 o'clock. If vol does contract, you can see that you'll find more profitability. Now, how much will vol contract? Well, you see that April 24th is currently at 61% vol. All right. So we're just adjusting the April 17th expiration. But let's say, right now, we could look at it right now. We're at 109%. Let's say we come down to, I don't know, let's say we come down to 95. So let's just contract this down to 95. This gives you a good idea as to how the curve will look. Now here's the other thing. I entered this trade a couple of days ago, and my debit paid for this trade was $47. This is the maximum that I can lose no matter what for this trade. It's 47 bucks. Now let's say if you went into this trade today, let's go ahead and pull up the TastyTrade platform. And I just want to show you how this looks if, let's say, you went into this trade today. Okay, let's pull up Netflix. All right. And what I'm going to do first is I'm going to look at the expected move of Netflix within this expiration cycle. So in order to do that, let's pull up the options chain. We need to look at the table, and we're looking at the April 17th expiration cycle. All right. So we have an expected move of, looks like this is right around 100, and then 113, maybe 115. So right between these blue lines is literally the expected move here. This is one standard deviation and one standard deviation. All right. Now, what I like to do is use Cloud AI, and I'll say, okay, well, what is the expected move of Netflix at the 17th April expiration cycle? This is after earnings, and I am aiming at a double calendar play. All right, so I'm going to do that. Let's see what happens. So it's going to look at, it may pull data from the brokerages connected to Cloud AI, currently trader in TastyTrade, by the way. All right, so it's thinking about it. It's getting market quotes from Tradier. You can see that. It's getting the options chain from Tradier. Let's see what it comes up with. All right. So we got a downside target of 99 and an upside target of 113. So profit zone 99 to 114. So we can say $100 at the put calendar and then 114 at the call calendar. So between 100 and 114, that's what we're looking at today. Now this has moved quite a bit since I entered it a few days ago, so my trade looks different. My strike placement is at pull that up again here, 90 and 110. All right, so I decided to go with the 90, which is a psychological level, and 110, which is another psychological level. So I decided to go with that. But let's say we do a brand new trade here today. All right, so let's just form this along the lines of the expected move that we just pulled up. So we're looking at 100 and 115. All right. It's currently at 106. Doesn't look balanced, really. Okay, let me just ask again. What is the expected move in either direction? All right. Yep. So yeah, it's right. So we can make this the psychological levels 100 and 115. You know, I would say do that. Usually you'll have more action at those psych levels. So let's just build a new trade off of that. But let's go back to the options chain and let's take a look. Let's see what we got on the options chain for this. So Netflix here, 100, and that's going to be the put. Our open interest is pretty nice. You got 14.8K. at the 100 level for open interest. That's nice. I like to see that. And let's look at 115 on the call side. 115, you can see we got right around 14K. So you can see that 14K is a lot bigger than the other open interest numbers. So that tells you that more than likely you have a good, healthy bid-ask spread. And then also you have enough activity there to be able to get in and out quite fluidly with this position if you do use these strikes. So I'm going to stick with the 100 and 115 strikes, and let's build a double calendar spread with this in mind. Okay, so with a double calendar spread, you sell the front month and you buy the back month. And let's look at what expiration dates I will choose. So we already know the strike prices. We're going to choose 100 and 115. And we already know what the expiration date of the front month is, which is going to be the expiration date right after the earnings announcement, which is April the 16th. That's tomorrow. I believe it's tomorrow morning. All right. So we know those pieces of information. What we're missing is what back month date are we going to use? Ideally, we want to see a big difference in vol, of course. And we can see here that vol drops off drastically at the 9-day expiration. So instead of paying for an extra time and going out to 16 days, this little 10 point or 10% differential, and then also this little bit of differential here where it starts to balance out. It's not huge. Let's just see how our pricing looks if we go with the 16-day versus the 9-day. Let's just see how the pricing looks with the overall position. So let's start to build it out. First, we are going to sell the front month. So we're going to sell a put at 100. And then we're going to sell a call at 115. All right. So if we were just to go on a, if we were to sell both of these, let's just look at our profitability curve here. It's basically how it will look. What did I do here? Options curve. Okay, there we go. So there we go. That's our curve. Maximum loss is to infinity. All right. So our maximum profit is 200 bucks, and we can keep losing. We don't want to keep losing. All right. Not at all. You know, this probability is great. It's a great probability of profit, but let's say something crazy and haywire happens and Netflix jumps 20%. Well, we're in deep water. We've now lost a lot. So we want to do something to strategize this and then give us some better profitability. And also we're selling high volatility here. You know, keep in mind that our vol was pretty high. Let's go back to the table. The vol is pretty high here. So we can sell the front month, high volatility. We want to sell high vol. And then we're gonna buy some lower volatility for protection. We're not gonna buy in the same cycle. We're gonna buy some lower volatility and for protection. Let's first look at the cost of buying on the 16-day May 1st expiration cycle. So we're gonna buy the back month, put at 100, and then we're gonna buy the back month call at 115. So there we go. That's how that looks. May 1st and April 17th. Now let's look at this on option strat. Let's build a new strategy. Let's go ahead and just say we're gonna sell a calendar spread. Let's see here. Sell a put calendar. Okay. So we have the 100, and then we're gonna add a buy call and add a sell call. And then let's go up to 115. All right, we're going to sell the front month. I'm going to change that to April 17th. And we're going to change this to April 17th. And then we're going to change this one to May 1st. And we're going to change this to May 1st. There you go. So that's how we're looking. Our maximum loss shows as $122. Maximum profit is $352. The duration of the trade looks like that. That's basically how we're looking. One thing you'll notice is that it's calculating a probability of profit of 91%. That's a really good number. I like that number. So I wouldn't complain if I was to look at my max loss and capture 25% of this number before the announcement, before you have a chance of anything happening where you lose out on this opportunity of capturing some easy low-hanging fruit. You know, let's say you go in this today, and let's say you take profit sometime, let's say sometime today. Let's see, later today. You might be looking at $30, you know, 30, 160. Yeah, that's 25%. $30 at 122. It's around 25% there. Let's say you want to roll the dice and let earnings announcement happen. You might be dealing with a lot higher profit. You know, you might be okay with capturing a bigger profit. You know, you might have a change in vol for the April 17th cycle, let's say down to 95. So you might be dealing with $100. You know, you might be able to get that. I'd be okay with doing these calendar spreads or double calendars all the time and capturing 25% of max loss. I would be okay with rolling that continuously on these plays. It's easy money and very low risk if you're able to manage your trade before the actual announcement, you know. But you could let the announcement roll out. You know, your max loss here is 122, and immediately when the market opens, you want to be looking to get out of that trade. Then take advantage of that vol crush. It's called volatility crush. That's what happens when the front month has the announcements and the vol, the uncertainty, leaves the market. It's called vol crush. All right, so that's basically what we're looking at, you know, with the double calendar. You want to center your strikes right around high interest or high open interest, tight bid-ask spreads, and then also around the expected move. Now, you could also play this directional. You could say, I believe that Netflix will have a positive earnings announcement and it will go up because, you know, 70% of the time that happens with Netflix. So you could say, okay, well, I'm going to remove this calendar on the downside and I'm going to play it on the upside. You could try to capture a probability of touch type play. And you're basically looking for price to touch this zone after the announcement. Your max loss here, as you notice, is $61. So it's a very cheap way to play the market, and you center it around expected moves. And then vol crush is basically the profit that you make from these plays is due to the volatility crush. So, and then also keep in mind that you can always manage these types of trades before the announcement, just from the passage of time. You're gaining money off of the passage of time. Theta is working in your favor. So this is a great way to play it. Now, let's go back to this Claude AI. It's called MCP, and I'm able to plug up an MCP into Claude AI and communicate with Claude AI and say what I want to do. So I can tell Claude AI, for instance, show me how it looks putting on a double calendar at 100 and 115 strikes. Expiration 17th of April and 1st of May. Let's wait for it to give me the numbers here. So it's constructing it in option strat. It's also getting quotes. So I programmed this to basically generate my option strat link for the trade itself as well. My max loss, it says here, is 122 bucks. And it shows the profit zone between 100 and 115. It shows the expected move. It says my strikes are just outside the expected move, giving shorts a high probability of expiring worthless. So that's what you want. You sell vol, or you sell premium, and you want it to expire worthless. May first long legs retain time value and benefit from any residual implied volatility. It's a very clean setup for $122. And it asks if I want to place it. So I already have it in my broker, but so I don't need to place it. And of course, my strikes are different. I could put on another one today, just to give me some more coverage across the movement, being that price has moved quite a bit. I was kind of hoping to capture something over the last couple of days, but it didn't work that way, which is okay. I could still keep it on as I have it, and I can still also add a calendar elsewhere that's cheap. And if one of those hits, and let's say I decide to let one roll until expiration, that could be a big little lottery ticket. Let's view on option strat. Let's see if this actually works. And yep, it formed the trade for me. 100, 115 to strikes, the right expiration dates. We can progress over the course of time and see how the trade works. And then there you go. One thing we can't know right now is how volatility will react after the earnings announcement, but at least we have an idea of how this should look. You could have a dent in here where you have some red in the middle of your structure. Sometimes that does happen, especially after the announcement. But usually that balances out. Usually that will balance out, and usually you'll have a healthy curve after the announcement, and you'll have a chance of capturing some of this move in volatility. And then if you do get price gravitating towards one of the strikes or the expected move, then you definitely don't want to let it exceed that when the market opens back up and you start losing. You definitely want to take advantage of whatever you can get, really. You play these high probability trade plays for dirt cheap constantly. And, my strategy and my approach is, hey, I'm happy with 25% of max loss. In this case, 30 bucks. I'm happy with that. And you keep doing that on these types of trades, and you'll see that you start to build a system of consistency And every now and then you may have a loss, but overall, you should be pretty good with, capturing a quarter of your risk, and then doing that, more than 75, 80% of the time. Your probability of profit is 91% at expiration. That's basically what this number means. So that you may have about a 95% chance of profit before expiration, and that's really good. So keep that in mind. You're not always trying to get the whale. I mean, you can go for a little fish and go for a lot of little fishes constantly. And this starts to add up into a part of your portfolio progress over the course of 1 year. So anyway, this is a double calendar spread on Netflix. This is a strategy of utilizing the expected move, which is calculated on your options chain. And then also you can look at the standard deviation as gravity points for your strike placement. And then also you want to focus on strikes that have healthy open interest. And then also psychological levels are always best, for that healthy open interest. Thank you for joining me today. You have listened to David here with DoctorVol, the lead trainer here at DoctorVol. I appreciate you joining me here on the channel on YouTube. If you're able to get something out of this video presentation, please like and subscribe. And also check out my affiliate links with OptionStrat, TastyTrade, and I have a couple others in there. Just take a look and see what you can use and add to your arsenal of tools to help you make better and more informed decisions. Have a great day and happy trading.